to YouTube as well, because this is a new experience brought to you by our friends in the cloud computing space. I hope everybody's having a good morning. It is Garrett Baldwin. It is November 18th, and we are here in the oldie times, the candlelight times of the internet, where things just don't work. This is one of those fun times. I actually like this because what happens in this environment is that we will spend the next 24 hours complaining about the fact that everything is very heavily centralized in this country, technology, finance, everything. And it becomes that kind of wake-up call that we are always looking for. And we'll spend 24 hours complaining about it, and then we'll never do anything about it as a people. So anyway, good morning, everybody. It is November 18th, not November 17th. So let me change that before I embarrass myself, if we haven't already done that. And there is this adage in the world. There is this belief that what is the belief that you are the center of the universe? That is known as, I believe, egocentrism, right? So the idea that I'm literally the center of the world is brought by the idea that maybe, just maybe, this show that has been using multiple platforms that are not Thinkorswim, maybe this is all one big controversy to force me in the morning to bring you each day and walk you through all of my trade ideas, everything through Thinkorswim. If I were a conspiracy theorist and an egocentrist, I would make this argument, but I am not, because it is too early for such arguments. I hope everybody's having a good day. To be very candid with you, I have no idea if there's a chat. I don't even know if this is working. So I might just be speaking out into the ether, which is, again, great television. So this morning, what we're going to be talking about is usually the same thing. It's not going to change just because we have a different platform. We are just simply holding on to one candle, and that will be a major theme of this market. Candle-centric trading today. Everybody upset about the technology. Let's dig into this. Look, if you're not shorting Cloudflare already, I don't know what you're doing. Cloudflare stock should be our basically entire focus today, because once again, you're down 4.8%. 192.55 in the middle of a major tech sell-off. You want to trade something? You want to trade deviation bands? You want to trade things bouncing around? Just go right to net. It's going to be there all day. It legitimately is one big gift for everybody in the market today. But as we're talking about this, we'll go through a lot of the different top stocks, top trades. This is not a trap day. We are in a pure negative momentum environment. And as I'm going to walk you through momentarily, the expectation with this, we have zero stocks in our breakout pattern at the moment in pre-market that typically can align in the next couple of days with a potential short squeeze. I would simply continue to follow trend and look for these moves to hit key technical indicators, key resistant lines, look for deviation bands, look for reversions as they come. But right now, this is not a very favorable environment for equities, as I'm going to lay out, and all eyes remain the same on tomorrow's earnings report out of NVIDIA. So let's dig into this a little bit today. Look, we are in an extreme breakdown mode. It doesn't bring me a whole lot of joy to have to share this, but look, this is what we have focused on so much of our attention going back to 2020. I take this very seriously because we have avoided every major pullback going back to 2020 by focusing on the math on the ends of the bell curve. And we have gone negative. We went negative last week on Wednesday, had a little bit of a pop, and then started to, last Tuesday, went negative again last Thursday. And we've been squarely negative again for the last couple of days. This market continuing to break down. A lot more volatility. We continue to emphasize the focus on the FNGD, the inverse FANG ETN, which continues to showcase that when we get above these 20 and 50-day moving averages on that very specific ETN, it signals market stress. Now, a lot of focus today, and you're going to see this in some of the headlines that we talk about, is the idea that there are valuation concerns. We have talked about that time and time and time again. Michael Burry saying valuations are stretched. Peter Thiel dumping NVIDIA. Lots of movement out of SoftBank. At the end of the day, money moves markets. Leverage moves markets. And in this environment right now, people are not talking about the stress in the financials as much as they are valuations because they haven't recognized how significantly the markets have changed post 2008. Now, with that said, in this environment, I am looking explicitly for, over the longer term, this type of pattern. This is what we call the 1% pattern. This is a period where we have a breakdown in equities, and then we hit a period where you have no buying strength. You have nobody stepping in to purchase equities, and that makes it very difficult for funds to dump more shares. Why is that relevant? Well, it's relevant because that's where we can see short squeezes, a push back above key metrics, key technical lines, and then the selling really hits. This has been the pattern of every major sell-off, really going back to 1987, but especially since 2008, 2011, 2015. So don't be shocked by short squeezes. That is the norm. If this is something much deeper, it will likely follow this pattern. We will then look for insiders to step in, policy accommodation by either the Fed or the Treasury. And then we will look eventually toward the long term, even if it is a short term, 2-3 month type of move, back to probably all-time highs. And I say that in jest, but this has legitimately been the way that the markets have operated for the better part of, 15 years. So in this negative environment, as we look at headlines and as we prepare ourselves for what the next couple of days look like, particularly with NVIDIA, we have to keep in mind that NVIDIA is the market. Wall Street has just had the biggest vol pop in a month as tech and AI leadership is wobbling. The earnings come on Wednesday, and they are a massive event risk. And as I'll walk everybody through today who is a member of our NVIDIA 4D, it is not about the earnings that they have. Look, you see this high digit, right? This focus on whether or not the company has quality earnings numbers, what is happening, particularly with their customers. At the end of the day, this is about positioning. So we're not going to make a big bet or a big expectation on NVIDIA ahead of time. We will trade reversions. We will look for breakouts and breakdowns in short duration charts. We'll look for moves to the extremes, but we're not going to pick one directionally, and we're certainly not going to buy options ahead of this report. NVIDIA earnings on Wednesday, again, are the single biggest event risk that we have had. I will likely be back here tomorrow to take you through the close and take you deeper into NVIDIA earnings as they arrive. The implied move is monstrous. Monstrous. High single digits. Peter Thiel's fund has already dumped its entire NVIDIA stake. Amazon just printed $15 billion in new debt to feed its AI capex. This is a story about debt, where capital is coming from. And Berkshire's Alphabet stake is an outlier. It is a quality AI name and search, but even some people are talking about irrationality. Hedge AI leaders, watch for reversion moves. Set up your deviation bands. I'm going to spend the last 10 minutes of this conversation today showing you how to set up the deviation bands on Thinkorswim. And then on top of that, we will talk a little bit about anchored volume weighted average price and how to utilize that after NVIDIA reports earnings. After NVIDIA reports earnings, we want to tap the highs and the lows of that day and then use anchored volume weighted average price the following 2 to 3 days in order to focus on what institutions are doing after such a significant risk event. The crypto crash, is that what the kids are going to call it? We have fallen under $90,000 temporarily, almost 30% off the highs, and has erased all of its 2025 gains. Again, crypto is a primary proxy of global liquidity. It has ties to gold prices and silver prices and bullish and bearish moves. But at the end of the day, crypto winters are tied to downturns in liquidity. And we have had a significant freeze up in the credit markets. We are seeing leverage leaving, and Bitcoin has been breaking down. So long as we are red in our momentum indicator, it is not safe to try to go long Bitcoin. You can look for bottoms. You can dollar cost average if you are long, but typically what we see is a continued dry up of capital is significant. This is a leveraged expression of AI tech risk and global liquidity. And when the most speculative layer pukes first, it's usually telling you something about risk appetite up the stack. Bitcoin is off significantly, and the Qs have held up, but there is a very nice little causal relationship between the NASDAQ and crypto. Once again, treat BTC as a liquidity gauge, and this can get very ugly for the QQQ very fast, right? Okay, so high beta names, junk growth, this stuff continues to be under pressure. This is the story. It hasn't changed. I was talking to Blake yesterday in the final hour. We said it was 2 months ago. It was 2 months ago. Blake and I, Brandon, Don had jumped in every now and then to make fun of my haircut. But we were having a conversation right after the Federal Reserve made its announcement in September. What was the conversation? That the secured overnight funding rate would move above the Fed funds rate. The SOFR is the overnight lending rate. This is our repo numbers. This is, once again, where all that leverage comes from. The ability to take money to the repo market, go back and buy a lot of high beta stocks, take them back to the repo market, get money, leverage that up, keep doing that over and over and over and over and over again. But here's the problem. The stuff that actually needs collateral, like to get funding, to actually, like I don't know, pawn shop, having collateral. The cost of collateral-based lending is higher than unsecured lending. That is backward, and that is showing you exactly what is wrong with the financing, the plumbing of the markets. We talked about this in September, the idea that the SOFR would raise above the Fed funds rate. It has moved as much as 30 basis points, I believe. That is significant. So we would not be doing this if we had ample reserves. We are not in an ample reserves environment. The New York Fed quietly had that meeting on Friday, basically telling everybody, listen, it's okay if you come to borrow money from us. They sounded like parents, right? The idea that we're always here for you, even though we want you to grow up and, be able, if you need money, if you ever need something, you can always come back to us. And a lot of people don't want to do that because of the stigma associated with it. The banks don't want to have to go back to the Fed because they don't want to get eaten alive by politicians. But the reality is the Fed basically said it is okay. Valuation jitters and debt, the private reality, collateral and funding costs are grinding higher. It is unusual to see certain companies that have cash flow coming in the way that they are going out and borrowing money. It's a sign of the times. So this is how the buy the dip dies. We've seen retail not stepping in. It doesn't happen with the headline. It happens with tighter plumbing and less balance sheet focus. And once again, the inability to expand your balance sheet on debt becomes an issue. We are focusing on the banking stocks. You saw it yesterday. Blake is all in against the banks, taking every single shot possible because this is where the stress really is. It's in the regional banking space. It's in the financials. And as I encourage you to just simply do, pay attention to the FAS and the FAZ. The FAS and the FAZ are these leveraged ETFs that are built around the big banks. But if we take a big step back, this is the FAS bullish, the FAZ bearish. Taking a step back and going 10 days. You see this spike? The way that this has moved, and if I should probably just get all this stuff off of here for you because it's what we're doing, right? This spike is a huge signal of stress in the banking system. And as this moves above its key EMAs, exponential moving average, I'm going to just throw this on here real quick. Give me one moment. You can't see it. That's okay. You don't need to see it. You just need to know that I am changing this to the 50-day EMA. There it is. There's your FAZ above its EMA. And that is stress. This right here is what happened back in March, back in February. This can be the beginning of something very significant. Even the stress we had in the repo markets back in December and January, a little bit of stress. This is the February and April stress. This seems to be the start of something bigger in the banking sector. And before we get to the runner, and I know that you are very excited about this because I still don't even know who I'm talking to. Maybe I've got Secret Agent Charlie. I know that Eric's there because I already traded an email with him. But really quickly, before we get to the runner, Home Depot, soft housing, nervous consumer. Oof. This one hurts. Home Depot comps only 0.2%, EPS miss, management cutting its full year guidance. Hello, we have a consumer that is under stress. Very clear. Very, very clear. They blamed fewer storms because that's nice of them in the sluggish housing market and the more anxious shopper pulling back on the big ticket spend. If the good U.S. consumer is fading at Home Depot, that is a problem for discretionary and housing linked names. Now, I am under the impression, and I have a very, very low rent conspiracy theory, that Home Depot and Lowe's are owned by two guys who went to rival high schools, built the exact same thing, painted it their school colors, and are still fighting over a football game from 1985 that ended in a tie. But that said, we have to watch Lowe's and Home Depot because, well, it really is a what side of the street kind of guy are you when it comes to Home Depot and Lowe's. Walmart, other big themes are under pressure and under focus. And this is a sign of bigger issues in the economy. They keep saying that the economy is running strong. It's running strong for the top 10% of Americans. That is where 49% of about consumer spending comes from. They aren't even worried about the bottom 90. The issue is this, and I'm going to stress this very, very clearly. There is a pocket of Americans. They make a very specific amount of money. It might be somewhere between the range of $150,000 to $350,000. Now, that's a sizable amount of money, but here's the issue. The taxes are going up. The property taxes are going up. The cost of living is going up. The cars that they drive are going up. When you start to lose 1 to 2 to 3% of that upper tier, that's 6 to 9%, right? The top 6 to 9%, top 6 to 10%. Every sliver of that is going to show up in names like this. It is a very marginal consumer. It is a very small sliver, but that sliver can lead to compounding losses in these companies. The moment that they lose these people largely on the backs of higher taxes in 2026 and other things, this is going to be a strain. This is an area of economics that a lot of people don't focus on because we're hyper-focused on the top 1% and the bottom 90%, but it is that consumer sliver, the top 5 to 10%, that have really been holding up the consumer spending in this market. And if that starts to fade, this will start to compress very quickly. Oh, one last thing. I know I'm teasing you guys. I'm not trying to do it, but we are going to get to the runner. I promise you. Meta and Blue Owl have closed a record $27 to $30 billion private credit deal in finance on data centers. Now Blue Owl is moving to block redemptions in a private credit fund tied to this universe that has tied investors up. This is the problem with private credit. It is turning private credit effectively into long-duration private equity. This is the part where things start to get choppy. People want their money back. And if Blue Owl does this, other investors in other funds tied to similar investments may start to try to engage in redemptions as well. We have to treat the private credit and the data REIT stories with caution at the moment. Focus on balance sheet strength and funding terms. And if you are in private credit, I am in FSCO. I own it. I know what I'm going through. It has been down. I'm being paid 10%. These things will follow stress in this repo environment. Once again, I am looking out to late 2026 for a rebound, and that is actually where I plan to exit. Okay, before we get to the runner, oh man, I'm just doing it to you guys. I apologize. Look, we have $50,000 in huge Black Friday giveaways, and I didn't know that they existed. I didn't know they made this for Garrett, but they said, Garrett, there's literally 50 of these for you, so do me a favor. If you're interested in any of my courses, we have different trading services coming up for 2026. You want to turn $1 into $2? Garrett Baldwin Theo credits. Look at that. Look at that turkey. I made that. Apply your first 2,000 credit to any of my masterminds or traded service alerts. These are first come, first serve, strict limits of 2 credits per person. Call 623-244-5657 and use your code word, Garrett. 2 T's. Okay, let's get this right. 2 T's. Do not be every teacher that I ever had. 2 T's. I am not an addict. Addict. A-C-T-I-C, addict. A Garrett. It also means sword. All right. Once again, you can win a F10 trading laptop. Claim your credit now, 623-244-5657. Code word Garrett, 2 T's, 2 R's. Don't get this wrong. All right. Here's your runner. Let's dig into it real quick. Okay. So we are focusing today because of the fact that I can't get my FinViz data set. We're focusing on a little bit of unusual options activity. So today we've got the Uber. Now, maybe you know the Uber. Uber is one of those names that is heavily leveraged. It is one of those stocks that gets a lot of attention from the leveraged hedge funds. And we're going to pull up a couple of moving parts here. We're going to add, and I'm going to do a couple of things. First off, to walk you through everything, I need to expand my screen because I don't know how technology works. Now, one of the issues with this is that I've got so many windows up, it legitimately looks like the Homer Simpson website that he created with the dancing deity. But right now, as I do this and I expand this out, and I do it very poorly, here we go. I'm doing it live. The zoom is too big now. Look at that. Just such a technologically savvy guy. That's what they call me. We're going to add our exponential moving averages and look at Uber first. And then we're going to look at volume weighted average price. So we're going to add move av exponential. Very exciting. And we're going to edit these real quick. So we're going to put this at 20. Don't want it to be blue. Let's get a different color in there. That's great. Very, very classy. We're going to do a nice white. I think we have red, white, and blue now. Look at that. Well, not really, but all right. We're looking for a little bit of strength, a little bit of a comeback here after a relatively weak period going back. Oh my God, this is chaos. Oh, I don't like that. Anyway, looking for some unusual options activity to the upside on our good friends at Uber. This is a Gianni stock, a classic. And after the sell-off that we've seen, we're looking for a little bit of upside, a little bit of a squeeze higher. Again, you're going to use the 3-minute chart. I typically use the 3-minute chart on FinViz to look for a continuation or a pop here. In addition to that, we've got DHR. I don't know what you do, but we're about to find out. Oh, yeah. Well, a little bit of weakness on that 5. Let's take a quick look here. Okay, this is breaking down. So we're seeing apparently some activity to the upside here, pushing above that 220 level. But let me take a quicker look at something else. Let's move this and let's change this to volume weighted average price. Let's get to what we're really good at, right? Volume weighted average price, you're going to add 3 of these. And on a day like today, where things are bouncing around, they're a little chaotic, we could see some very significant moves to the downside. We're going to make our first standard deviation lines. We're going to keep our second as is. Let's make sure we have a different color, and let's not make it red or green because that's just insane. We'll keep that there. We'll make the second one blue line. And then we're going to edit our third one, and we're going to make this third standard deviation, nay, to the downside. Now remember, I'm typically looking for a move outside the third standard deviation band, but here is where we lived yesterday with DHR. In addition to that, we want to add something. What do we want to add? We want to add anchored volume weighted average price. An anchored VWAP pulls up here. And what anchor VWAP will do, that's right, we want to use our version of it. Forgive me. There we go. We have our own little script. We'll share this in the chat with you, or I'll send an email around about it in a little while. And what we're going to do with virtually anything today is to connect it to the close yesterday. And what we're looking at is how institutions will respond to a name like this after yesterday's close. So we're going to go to 11:17, and we will change that time to 1600. We need to change the color so that we know exactly what it is. We'll make that the white line, and we'll apply that. And what you're going to see when you're following this anchored line, this will show up in the afternoon. What we're going to be looking for is the defense of that anchored line when we open up. So let's look at the SPY real quick. And let's just take a quick look at where we sit from yesterday. This is going to arc down. We're kind of moving lower. Obviously, lower the morning. Yikes. 660. If we anchor this to yesterday, let's take a quick look here, and let's go to the 16th. I want to show you how the anchor operated yesterday. What you're going to see here is that, oh man, this is all over the place. Let's, one second. Tied right to VWAP. Tied right to VWAP. All right. Well, again, this is what happens when, there we go. This is your trading session from yesterday. Here's VWAP, lined right up perfectly, by the way. Okay, that can't be right. So let's get off this. Let's just change it. Let's just stop talking about it because I'm apparently using this wrong, and it's too early in the morning. Let's get back to the runner. HWM. You can learn more about my inability to operate technology in my new book, MBA. It's a book about having multiple degrees, yet not being able to operate a microwave. All right, so forget forget the individual line here on VWAP, anchored VWAP. Focus instead on the fact that you have these names like HWM. This has continued to showcase lower highs, lower lows as we move lower through volume weighted average price, which is our purple line. We're gapping up to start the day. We're dropping under these levels, and then we're burning off through the day. A little bit of a squeeze to transpire, and then same thing, giving it back. Today, as we wake up, a little bit of a pop this morning, looking for this to fade, HWM. And if there is options on this, we're seeing it to the downside. Barclays, banks under pressure. Barclays is not special. We talked a little bit about the XLF yesterday. We talked about the regional banks. Same thing. Weakness creates weakness. With volume weighted average price on a daily chart, on a 1 minute daily chart, what you're looking for, particularly as you head to a Friday, if we gap up, if we see a squeeze, if we see a move up on Barclays, the trend for the banks is lower highs and lower lows. Well, typically, we would look for moves into the 4 standard deviation for an opportunity to bid back up, not in a pure negative momentum environment like this. We dropped under VWAP yesterday at 21.65, and we close out ugly day, $1. This is where you just stay in the money and you look for continuation and lower downside, either using volume weighted average price or a 3-minute chart. NTR, sad to see some of these names. These are good companies too. Same thing. Lower highs, lower lows. This thing bled off 2 points yesterday. We're seeing unusual activity around this. Now, with NVIDIA, NVIDIA is going to be, well, it is what it is, right? You see these pops, and then you see these drops. And what we're specifically looking for, right? We're sitting here at 9:17 in the morning, a little bit of a squeeze this morning. It is the continuation of lower highs and lower lows. We saw this overnight. We saw this move yesterday. We broke back under volume weighted average price and sold off. You don't have to just use VWAP. You can use inverse ETFs. And as you could see, these types of moves yesterday, this is a move yesterday off this first deviation line of 17. We pushed back above. And in fact, on the anchored VWAP, I remember this, we were here. Effectively pushed higher. This was a nice little move. 17 to 1777 doesn't sound like a lot, but a 5%, 4 to 5% move in a day using a leveraged ETN or ETF and following volume weighted average price can pay off significantly. So NVDQ, GGLL, I don't know what that is. It sounds like something related to the Goo Goo Dolls. Oh, the Daily Google Bull. Well, again, Mr. Warren Buffett stepping in, buying some stock, and the Googles selling off. Inverse positive flow, same thing, squeezing back this morning, 87. Looking for a possible sell-off in Google when the market opens. Look at Google, GGLL. I think there's a GGLD as well. HD, same thing. Look, we are post-earnings on Home Depot. This is where you break out the bands. This is where you have volume weighted average price. You look for moves. Not here, not here, not here. You look for moves down into the 4 standard deviation and overreaction, that capitulation candle, that fund just dumping. On top of that, though, just keep in mind that in this environment, if you're using the anchored VWAP, if you're using, and again, everything that I use is really heavily linked to TradingView, I apologize. I will get this thing fixed right. But if you want to open this morning and you want to anchor your volume weighted average price to the open and to the new low, you are looking for all action, all activity, all movement on the stock since it hit that low and what institutions are doing. And you trade around that particular anchored level, low of the day, and you're trying to get back to VWAP. With the compression of implied volatility, look for potential reversions later today, or at least some short covering. It's hard to see HD the way that it is behaving, but low is also going to be under pressure as well. You saw yesterday, little tiny moves, not significant, but if you can get a $4 or $5 move to the upside or to the downside, you're using short duration options into Friday. Lowe's reports later this week, I believe, so be cautious there. And then, of course, the UVXY. This thing is just, this is your most important tool for the next 24 hours. I'm not telling you to trade the UVXY. I'm just simply pointing out that you need to have this out. You need to have this up on a screen. And the reason for that's pretty simple. Because when this breaks out, look for tech to roll the other way. Look for tech to move lower. Look for Palantir, NVIDIA, Bitcoin to move lower. But when this starts to go the other way, and you look at what's called the SVXY, forgive me, the short ETF, when this starts to rebound above VWAP, that is where volatility is suppressing, and that is where we start to see a little bit of relief rallies that could be temporary. You keep the UVXY and the RSXY open, you'll be in good shape. It is 9:20. I made it through this. I only made like 4 mistakes, maybe 10. I don't know. But the point is this. This is going to be a difficult environment, right? And just to give you a real quick look at our good old friends in the gold area, gold selling off, crypto selling off. And yeah, I'm pulling up CNBC because, look, it's relevant. Asia got smoked yesterday, right? Everything is under pressure. Watch these headlines. This is my point. You're seeing these headlines that are coming across. We're having one of our frustrating positions and buying a stock on weakness. Why? There's no clearance yet. Bitcoin breaking down because of valuations. Look, at the end of the day, this is all about plumbing. You're going to see doom scrolling in this environment. You're going to see a lot of fear in this environment. People are starting to panic about the very things that we were talking about 2 months ago. So in this environment, you should be prepared. You should be excited. You should be happy to take advantage of the volatility, paying attention to what Don is talking about in expected moves, paying attention to what Blake and Brandon are talking about. Pay attention to where Gianni sees momentum potentially returning if and when it returns. This is where you start to see these pictures. And Don, give me 1 second. I want to point this one out. These are called sensitive traders. You're going to see these pictures pop up. These are sensitive traders. They have their hands in their heads in their hands, and they're panicking a little bit, and they're looking at screens, and they're sad, they're sensitive. And when you start to see more and more of these pictures and it starts to get a little bit out of hand, like literally everywhere you look, that is probably your contrarian bottom. The moment that you see lots of sensitive traders and you also see people talking about the Great Depression, that is going to be your bottom. But in this environment, pay very close attention to these headlines. Cloudflare Net is a gift to everybody today who is trading momentum and reversions. Be back with us. We're gonna figure it out. We are very agile. That's why we have this YouTube channel. But once again, I want to thank everybody for taking the time today. Finally, last thing, get your Garrett tickets. Get your Garrett tickets here, right? 623-244-5657, code word Garrett. Turn your credits 1,000 each, turn a buck into $2. Apply your $2,000 credit to any of my masterminds or trade alert services. Limited to 623-244-5657. Whoever's out there, thanks for joining me today. I'll talk to you guys at 3 o'clock when I am back in the afternoon. Have a great trading session.
All right, let's get things started this morning. We'll see how this goes. It's been a long morning already. Obviously, we have some technology issues, not necessarily at Theotrade, but worldwide technology issues right now affecting millions of sites. I can't even access ChatGPT. What's the world coming to? That and yeah, let's make sure everybody's good. That and I decided I have the hiccups over here right now, so we got that going for us. I'm just making sure our numbers are okay in here. We can't necessarily communicate. Some people were able to find us this morning here over YouTube. We're having a limited capability to even email people right now with Cloudflare down. So yeah, this is quite interesting. This is actually bigger than AWS being down, in my opinion. Anyway, because I can't access ChatGPT. I can't even have a conversation without ChatGPT. I mean, it's hard to talk to anybody. I'm just looking right now on my end. Yep, everything's still down. It's been hours now. It's quite impressive. All right, let's get to it. Let's get started. I apologize. I do have the hiccups. I'm like walking over to my desk this morning. All of a sudden, the hiccups start. The hell, it's all going downhill. I can't even have making sure that sound is good. Okay. So welcome everybody. It's Theotrade chat in an unusual circumstance today. We are broadcasting live here into YouTube. So S&Ps are down from 35 handles this morning. It's kind of cool though. Those of you that actually have found us, it's great. You know, the ability to broadcast elsewhere. We'll try to get a message out to everybody here as we come into, of course, this morning's open call. So not too worried right here. One thing I do want to make mention of immediately. I had some people that told me they could not get out of the XLF yesterday. So I left a few contracts on. My exit price yesterday was $1.16. Again, my exit price was $1.16. I'm going to go ahead and try to exit a few more contracts at this point, and I'm going to actually hit them at $1.17. So that was a rather easy fill. I just wanted everybody to be aware of that. So again, very limited numbers of people on here. By the way, somebody said text message work if email doesn't. Yeah, good try. It doesn't actually work because you have to log in for it. Believe me, we can't email, we can't text, we can't do anything. We can't even get to our own servers right now. It's pretty wild how bad the outage actually is because we use third parties. So this kind of thing can't happen except all the third parties. They all use Cloudflare. What do you all have in common? We all use Cloudflare. S&Ps this morning are opening relatively weak. The advanced decline line, though, I want to start with this right off the bat. That is nowhere near correlation, nowhere near correlation. So once again, you're left in a position here whereby out at $1.17. Nice. Okay. So a couple of people that had trouble getting out of the XLF are out. One thing that's incredibly important to be able to discern this morning is exactly this. Without correlation, okay, without the advanced decline line picking up to the downside, do not even consider, don't even think about the idea that this is real sell side activity. We may be oversold. It does not matter. You have to see higher degrees of correlation, and we're not there. And that's not me all bared up. You want to see like a bounce in the marketplace, and you can get a bounce in the marketplace. The problem though is those bounces are only going to be temporary unless you got to see full-fledged sell-side like activity across the board. There's nowhere to run to, there's nowhere to hide. And what we're continually seeing in this marketplace, and that it almost like plagues us, if you will, is the fact that there's pockets. Like even today, Apple's got a bid under it, Google's got a bid under it. There's pockets and rotations still effectively going on. This is capital trying to seek a home. And again, I want to reiterate what I just said. It's not that we cannot see a rally. Look, okay, you just shot up a couple of points in the last couple of seconds over here. It's not that we can't see a rally. It's that the rallies are not likely to be any There's nothing sustained behind them. And that's simply because we're seeing these pockets and these rotations of strength and attempts to rotate out of this. The truth be told, though, you got to have kind of that, what I term a full court press hitting the marketplace to feel that sell side activity is actually over. We're going to look at some individual positions today. Still got stuff on Starbucks. Starbucks is right on the dance floor, right where you want it for that in-out spread. I have very, very limited positions left on right now. I have closed, once again, almost everything we've had on profitable. So pretty much everything we've thrown at this marketplace has come off profitable. Take them if you can get them. We close the XLE, we close the XLF. I'll go into some detail about those. The NASDAQ right now is on a rip in this first couple of moments of trade. Okay. At least at this point, you're like looking at the NASDAQ rip back, just time out for a second. What's volatility saying? It is dropping. Okay. But not of any critical significance at this point. So it's like, if you will, the market, that is the S&Ps, maybe had a momentary lapse of reason. Okay. Keep your head in the game. This is volatility right now, right? And the VIX, I'll use the VIX. I'm not a big proponent of VIX, but VIX at this point is up to 23 and change. Just making sure we're good here. VIX is up to 23 and change. And I just want to make a quick timeout in there. Okay. This is not the market that you were in 3 or 4 weeks ago. This is not the market that you were in all summer long. Okay. This is a completely different animal. And to point that out, like, again, as I often say this, I'm not a big advocate of VIX. I think it's a pile of crap. It's very backward looking, but it definitely serves a purpose. And that purpose right now is to display this to you. Okay. Look where we are in terms of volatility. Because I want to reiterate the seriousness, okay, of the nature of this marketplace to you. The volatility, okay, this last few years. This is all COVID, okay, a little bit more like it was chaos, 20, 21, 22. You actually had a bear market in here too. There was this pretty hideous sell side activity going on at this point. But just stop for a second, okay? Because all of this in here, I'm going to box it out, okay? There's only a few instances since, 23, 24 into 25 in the last 3 years. Now I'm going to zoom in, just bear with me for a second. So let's go the last 3 years. In the last 3 years, look where volatility is. As they said, I don't like using the VIX because the VIX is not a great gauge of overall risk in the marketplace. Okay. It's very, its pulse is delayed, to the market. So you're kind of seeing risk like after it's happened. I don't want you to use the VIX on an intraday basis. Okay. But on a day to day, just to point one aspect out, risk right now, okay, has only been higher a handful of times. And that's why I want to express the seriousness, okay, of this, because right now I have 1, 2, 3, okay, 4, 5 other instances, okay. Again, and this is a pretty big instance right there, right? So I would actually assume that this is all one. That's one. Here's 2, 3, 4. There's 4 instances, including obviously right over here. Okay. You got 5 instances of the volatility being higher than this level. Okay. In the last 3 years. Okay. So great. Whatever. The volatility's up there. Yeah. But that changes the nature of trade entirely. And people have a really tough time changing gears. It's it's a really tough time being able to change gears. By the way, we just sent out the link right now. Sweet. Okay. Yeah, people are finding us. Some people are now getting emails. We couldn't even log into our own email this morning. That's like people send a text message. I'm sorry, I couldn't log in. Okay. Why? Cloudflare runs it. So welcome if you guys are just joining us right now. So we are broadcasting on YouTube today. It's yeah, we'll see when Theotrade comes back up, but actually Theotrade is back up. Okay. I'm going to broadcast into there as well. Okay, I'm actually gonna continue to broadcast here, and I'm gonna continue to broadcast into our usual location. I'm just looking right now as people are coming on. We're coming back up. Sorry, as we're working through tech issues, they're not really our issues, but as we're working through tech issues, okay, it's a fluid situation. So as I was stating about volatility, the market, okay, is a very different animal right now. As I was saying, like people, they can't switch gears. Okay, there's still the gear of it's buy the dip, it's buy the dip, and it's all right as long as you're going to be defining that risk, okay, in every means possible. Because what you are seeing right now is that the buy the dip, and I really, by the way, I hate that term, but the buy the dip is actually turning into, okay, sell the rip. And that's, the side of it that people just haven't seen much of, in a very significant period of time. The charts right now, look, you can read into the charts all you want. I would say that if you're going to read into the chart, to be honest with you, go to a 30-day 1 hour in the S&Ps. Okay. So this is the S&P futures. Um, the, uh, hold on. I may lose host capabilities for 1 second. Bear with me as we're going to broadcast to a couple of different locations simultaneously. Good to go. So you guys are going to lose me for just a second. So hang with me here as we are going to be broadcasting into our main room as well.